So yesterday we talked about how with the S&Ps butting up against all-time highs for the third time in a row, the post-Fed move was unlikely to resolve by gently going sideways. It was either going to break higher or break lower. I also mentioned that the first move after Fed Day, i.e. the move of the market on the day of Fed Day, is often, quote-unquote, the wrong move. And very often it gets resolved in the opposite direction the following day. That's exactly what we saw on Thursday with a strong move up in equities. S&P was up 1.7%, NASDAQ was up 2.5%. All right, so things are looking bullish again, obviously, with the index making new highs. The NASDAQ is some way away from making new highs, but it does appear to have broken from this little downtrend line. Same with the semiconductors. This had been a bit of a warning sign for me. The fact that it was stuck below its 50-day moving average and this downward sloping trend line. Well, on Thursday, it closed above both of those key levels. Now, I always like to see two consecutive moves above a level or below a level to confirm a breakout or a breakdown. Looking at pre-market, it looks as though it might actually end up back below the 50 at least, but we'll see. These pre-market indications are often not that helpful. Another observation I'd share with you is that yesterday it was big tech that really stormed back. The Mag 7 had a huge day, tech had a huge day, semiconductors had a huge day. The sectors that didn't have huge days were consumer staples, utilities, real estate was a bit of a mixed bag, as was healthcare. So what's going on here? Well, it looks like we could be on the verge of some sector rotation. Now, one day doesn't make a trend, but if you look at the very defensive sectors of the market, like utilities, that was at a new all-time high a couple of days ago. XLP has been very, very strong. A little bit of profit taking just recently. XLRE has been a storming sector as well. And of course, healthcare has been very, very strong. And healthcare can dance to the beat of its own drum because even though it's defensive, it does have some attractive growth characteristics as well. But it looks like what we're going to see in the short term is some selling out of the more defensive sectors like XLU and money pouring back into sectors like XLK, which is tech. Communications has broken higher as well, and consumer discretionary also breaking higher. And what's driving this? That a lot of money has poured into defensive sectors in the last few weeks because obviously the market's been going through a growth scare with decline in US economic data across the board. Now, with the Fed clearly kind of having the markets back, we got a 50 basis point rate cut. The market is kind of throwing away recession fears for the time being and is reallocating from those more defensive sectors into the more growthy sectors of the market. At least that's what happened yesterday. Like I said, one day doesn't make a trend, but this is a movement that bears watching. That's what I got for you. I hope it helps, and I wish you a wonderful weekend.